Hello everyone and a warm evening to all of you. I am Meghna Datta, your host, and welcome back to CF Thursday. But before starting, let me give you a rundown of CyberFrat. We are an enterprise risk management community with special focus on cybersecurity, risk management, and emerging technologies. We are the fastest growing community with 20,000 plus members globally. We have a presence in over 50 plus countries, 90 cities, and 307 Indian colleges. Our members consist of students as well as professionals who are continuously reaping the benefits of being a part of a network as well as contributing to making it bigger and better. So we conduct a lot of knowledge sharing sessions, webinars, and workshops through the programs like CF Thursday, CF to Connect, Fireside Chats, which are taken for our members by the subject matter experts or industry leaders. And it is absolutely free to learn, attend, as well as earn certificates. So you will also be receiving a participation certificate for today's session. All you need to do is attend our session for at least 40 to 45 minutes and fill out the feedback form. The feedback form pops up on your screen once you end this session. So Cyberfrat is launching InfoSec Fusion for its fifth anniversary. And it is an opportunity which I'm sure none of you would like to miss out on. So make sure to visit our website and register yourself for just 555, which is the 90% discounted price. So make sure that you go and register yourself before the prices increase. Also, make sure to get all your questions answered in today's session. You can put your questions in the question box and I can read it out for you, or you can also raise your hand and get yourself unmuted and directly speak to the speaker. So now coming back to our session for today. So today we have a session on decentralized finance. And to deliver on the topic, we have with us Mr. Narasimha Langovan. He is a futurist, a GRC professional, keynote speaker, and partner of Ken & Co. Chartered Accountant. He specializes in office automation, digitization, and automation solution, in addition to areas such as data analytics, risk-based audit, and privacy impact assessment. It's a pleasure having you here, sir. The platform is all yours.
Thank you so much. Just give me a quick minute. Let me know if you're able to see my screen.
Yes, sir, we can see it. Yeah, great.
And I'm presuming my voice as well as my...
Yes, everything is perfect.
I am visible. Perfect. So the 3 checks are done. Thank you so much, Cyberfrat. Thank you, team, for inviting me to share my thoughts. I'm sorry, 1 minute. Resume slideshow. Here we go. Okay, so quick intro about myself. I'm Narasimha Langovan, a practicing chartered accountant by qualification, but my specialization is into technology and automation, risk consulting, and infosec. I've always found things the emerging technology is very innovative, very exciting. And over a point in time, I intend to keep on exploring, and I always call myself as a learner because there is no end to this world of innovation. I am a national and international speaker. I've spoken at various forums, including at the ISACA CAX, which is held across the globe. And in addition, I'm also an author. I've shared my thoughts, either co-authored or solely authored a few guidance notes for the institute, and I keep on working to do much more things. A general disclaimer: the views what we discussed is of my own, not my firm Ken & Co. That's just to bring you the perspective. Okay, so what I'm going to do is I'm going to have a very simple and an easy agenda. 5 broad things I want to cover. First and foremost is what exactly is DeFi or DeFi, however you could call it, decentralized finance. Second is the relationship between blockchain and DeFi, which is very critical, because blockchain is the basis through which DeFi as such works. There are a few other protocols as well. Third, how is it impacting finance? What are the changes? What are we seeing? And then we'll probably head into what are the opportunities and challenges in DeFi. And maybe we'll look into where the future of DeFi is, probably a few insights and thoughts, just a slide to say where the world is heading into. So let's first hit agenda point number 1. What exactly is this decentralized finance? Why is it making so much of noise? Just to bring you to the context, DeFi is not something new. It was already in existence. But what happened was in the year 2020, there was a huge growth in the way applications or systems or innovations started coming in decentralized finance. And that is where a huge amount of attention came into picture. And a lot of people are talking about it. Okay. And we'll see what that is. And let me remind you, decentralized finance is not just Bitcoin. Okay, because the moment you say blockchain, DeFi, everybody says, oh, Bitcoin hai. I know that Bitcoin fluctuate hota hai rehta. Just to bring you to the context, I think Bitcoin 2 to 3 months back, it almost touched 60,000 US dollars, and now I think it's trading at about 29 or 30,000 or around that range. I've not tracked the today's or the latest thing, but what I know is almost it has got halved. Why? What? We'll not look into it because it's not a session on Bitcoin, but I'm focusing purely on decentralized finance. So let's explain the few basic concepts. See, what happened was people started thinking Bitcoin became a major exercise, or Bitcoins rather became one significant revolution. And of course, we are seeing that people talk about it, cryptocurrencies. Generally, cryptocurrency is the broader terminology, but Bitcoin is what everybody speaks about. There was a lot of noise about it, including the Supreme Court of India saying that the RBI banning the Bitcoin or sort of transactions, and then Supreme Court of India coming forward and say, hey, that is not a valid method. You need to probably relook into it. And then subsequently, RBI recently also clarified that you just have to follow some KYC and anti-money laundering procedures, but banks need not impose any restrictions on it. Well, that's on the one side of the story. What Bitcoin did was it popularized this technology called as blockchain. What is blockchain? In a few slides we will cover, so just hang on into it. Those of you who are already aware of it, nothing wrong, we will relook into it. Because here we have a mixed audience and I need to address all of them in a uniform way. So let's look at what Bitcoin did. What Bitcoin did was it ignores all the hype. Let's only focus on the concept. It removed the need for a central regulator, rather brought in a concept called a decentralized regulator. I would not use the word regulator because when it is decentralized, you are bound by your internal procedures and protocols. Let's take a simple example. You and your friends go out for a party and each of you decides to spend some X amount of money or funds for a particular purpose, maybe for travel, maybe for tickets, maybe for entertainment, maybe for food. Now you have defined your internal rules. And as long as whatever you incur, your rest of your friends agree, the transaction is okay. That means, is there a single person who is controlling this entire setup? The answer is no. Unlike the existing monetary system, RBI controls the banking, IRDA controls various things. So this became decentralized, which is more democratic in nature. Okay, it has its own pros and cons. We'll come to it a little later, but it has its own pros and cons. So when it became decentralized, the possibility of anybody and everybody, or rather a large pool of players coming together, forming a set of protocols and started controlling came into picture. And that's why Bitcoin was considered as a decentralized currency. But what people thought of it was, let's look at the Bitcoin concept and let's say, can we develop something on the finance fraternity which is completely decentralized, which means there is no single player who manages the entire show. A classical example is today, if you and I want to buy shares of, let's say, any of these companies, I want to sell it to you, you want to sell it to me, off market we can do it, provided we both know and we write an agreement and whatever, sell it, etc. But if you want to exchange on real time over this thing, the only way we can do it is through a broker, and the broker has to be a member of a stock exchange. Now, given the scenario that we have multiple players and of course stock exchange plays the key role, now can I eliminate the stock exchange? Can I eliminate the centralized player whereby in a decentralized manner I'm able to do it? And that is what this technology aims at. It is at nascent stages. It is at nascent stages. And for all you know, it's time for us to get into these concepts and understand. Who knows, this may become a future potential opportunity. Many students attending out here, many youngsters attending out here, including my. Okay, so all of us may have probably interesting opportunities coming up. So it's a broad term for financial services that is built on the foundations of what is called decentralized technology. And one of these very, very popular decentralized technology is what is called as blockchain. Again, we will look into blockchain in a few slides. Now, what happens is this DeFi, okay, it was based on multiple D apps, decentralized application. Let's presume that application to be something like Uber, Ola, whatever it is. It solves a particular problem. But in a case of a Uber or Ola, Uber or Ola controls this mechanism. There is a party who controls it. Imagine there is no party who's controlling, but it just operates on a democratic manner where I request, you accept. Correct? And that is a methodology which is being adhered to. So it's a general term for evolving trend which you notice. And let's be reminded that this comprises of various technologies, business models, and lot more things. So it's just not that one word, it's very large. It consists of digital assets which operate on top of a base layer settlement platform. All these fancy terminologies, one by one, we're going to decode so that you get a perspective. So what are these building blocks of DeFi? The first and foremost building block of DeFi is a blockchain. And what is a blockchain? It's a network. It's a distributed ledger. And what is a ledger? Ledger is something which has a track of who owns what and how much is it. For instance, if you go to a bank and say, hey, can you give me my ledger? Or rather you ask me, can you give me my statement? You would print it, or you would say, go to this website, enter the credentials, log in, whatnot. Now, what did they do? They are keeping a track. Same way, a blockchain is a system which is a typical ledger, but it is distributed in nature, okay? And this is being used as a settlement layer for the transactions. That means the underlying layer is blockchain. So you perform any transaction on a DeFi system where you have a buyer, seller, vendor, whatever, or a borrower and a loan provider, service provider, whatnot. All of these transactions get settled on an underlying blockchain. Okay, we'll go into a little more of blockchain in a few slides to come where I speak about interrelationship. The second is a very, very important term you have to understand: digital asset. Now, a digital asset is something which represents a value that can be traded on a stock exchange. Which means, are you trying to say a digital asset is a cryptocurrency? Yes, but not just a cryptocurrency beyond that. Digital asset is a very, very broad word. Anything which you can digitize and you're able to trade it. Let me put it in a very, very simple language. Let's say you have a piece of land, 10 acres, and the smallest size of land which can be divided as per the local regulations or whatever you agreed upon is, let us presume, 1/10 of an acre. 1/10 of an acre. So you have how many acres of land? 10 acres. So 1/10 of an acre, that means every acre can be divided into 10 pieces, and 10 acres, that means 100 pieces. So these 100 would be considered as a digital asset, and that is the maximum available land which can be traded. Just like how you know the maximum available Bitcoin is pegged at something. Correct? So now this digital asset, I've got this land, I've put it into a digitized form, and for each of them, I'm able to earmark where is the physical structure. So this can also be considered as a digital asset. But what you trade is not that piece of the land, but a token which represents that piece of land. Correct? Likewise, you can have it in currency. Likewise, you can have it in any sort of an asset which can get digitized. Third, wallet. I'll put it in simple language as the name wallet suggests. A wallet is a place where you're storing money, your physical currency. Now, this is where wallet is a software, it's an interface for users to manage assets stored on a blockchain. A very simple example. Now, if I say I have got an email, where is it? It is residing in @gmail.com. It is residing in a particular place. A wallet is quite similar to that, where it is an interface for you to manage the assets on the blockchain. You have those assets in that particular premise. And then comes the most powerful thing called a smart contract. In fact, the evolution of smart contract is one of the biggest advantage which is brought in all of this innovation which you see. In a layman's language, I would probably say a smart contract is a self-executable contract. Just like an .exe file, you double click it, there are series of steps which happen and your software is installed. The same way, a smart contract is a set of instructions which runs on the blockchain. It gets a trigger from an event. Let's take a simple example. There was a situation where a crop insurance was taken, and based upon the land which was very dry, there was no rainfall, whatnot, the sensors send an information to the insurance company that, hey, there has been some issue out here. And to top it up, there is some sort of an alert which takes place, and the government declares that region as drought. Now, given these things are sort of matching, reconciling, whatever, imagine the insurance company automatically makes the compensation to all your accounts, all the farmers' accounts. What are we doing? It is a contract which carries out a set of rules, controls, whatever, or an event based upon a predefined terms and conditions. Okay, it's like saying that through by virtue of a smart contract or by virtue of the smart contract being placed on the blockchain, auto execution of certain things are possible. Now this gives an element of trust. Okay, let's also look into something called dApps. D-apps, popularly called as, some people call it as dApps, some people call it as D capital APPS, whatever. In simple language, it's an application built out of a smart contract and which is integrated with any other application, just like how you see a mobile app. It could be even like something like a Facebook, WhatsApp, whatever. For you, you would just see that app. How the backend works, you may not be interested. I mean, you may be interested from a knowledge sake perspective, but from a utility point of view, you're not. Correct? So the software applications built on this is called as apps. Let's not forget governance system. Now, why is this crucial? See, you are replacing a centralized authority or a person who's going to be heading certain things. Say, for example, if RBI is not there, would you be trusting that 100 rupees or 1,000 rupees note or a bill? The answer is no. Why? Because every currency is backed by the government, backed by the RBI. Correct? Of course, the earlier, and this we call it as a fiat currency. Okay. Of course, the earlier method was every currency was backed by gold reserves, but that system, after a point in time, countries stopped following it. So governance system, what happens is there we in a centralized method, you have a set of rules. In the case of a decentralized, don't you think you need to have a set of protocols? The answer is yes. So these are mechanisms driven by software algorithms that manage the smart contract or blockchain protocol or these tokens so that the stakeholders' rights and interests are protected. And then you have autonomous organizations. So these are those rules who are enforcing in the form of a smart contract. For instance, replacing a stock exchange, you may require a decentralized stock exchange, DAX, correct, or a decentralized exchange, which is performing or connecting various people. So therefore, you require this autonomous organization to do certain activities. Then you have something very recently which is making a lot of noise called stable coins. Now, when you are trading with, when you're performing or doing all of these services on this DeFi setup, obviously you're dealing with monetary transaction. Now, let us say you bring the physical currency to do this transaction, the entire purpose is defeated. You need to have something on the digital platform. Now, can I use my normal means of currency? Yes, that is a solution, provided everybody agrees upon. Or I can use certain things like the cryptocurrencies, which is already there. For example, the Bitcoin or Ethereum, Ether as the case. But little do we realize that the prices of these currencies fluctuate. There was a tweet from Elon Musk, and the price either went skyrocketing or started falling down. Just a few days back, it almost fell $5,000 in a span of a week's time. And that sort of a cycle is actually continuing. There have been a lot of trends, and anyways, your crypto analysts will talk better on that. But what happens? Imagine if that was a means of currency for you. Let's say I said, whatever transactions you do, let's do it with Bitcoin. Of course, one country just legalized Bitcoin as an acceptable currency yesterday. I forgot the name. It's some small country, I think in the European or one of these regions or African regions. So what happens in scenario like that? You may probably buy a pizza today. Today you may buy a pizza with probably hypothetically, let's say 1 Bitcoin. And tomorrow, because the Bitcoin price has crashed or it went up, you may probably buy it at half Bitcoin or 10 Bitcoins. Now, in a span of 2 to 3 days, if you have so much of fluctuation, what is the guarantee that your currency is trustworthy? And that is where a concept of a stable currency came. A stable coin, sorry, I beg your pardon, stable coin. A stable coin is something like a cryptocurrency. I will probably call it as a digital asset because it's a broader. It's a digital asset whose values are linked to a fiat currency such as dollar, and dollar is the most accepted. Or it could be a basket of fiat currencies or any other stable asset. Let's go back to the traditional method where we're talking about the barter system. I used to give one cattle, you used to give me this much of food, asset, whatever it is. Correct? So what you want, you decide. But obviously, most acceptable is dollar, and therefore it is pegged against that. DAI is one such currency which has actually been working. And the last is a very interesting concept called Oracle. Oracle are those players or parties who are outside the blockchain network but need to give some sort of an assurance to the blockchain network. Let's take a simple example. There is an insurance contract. A person met with an accident. As a result, the typical Indian law legal procedures takes place where an FIR is registered, certain documents have taken place, and that document has to be submitted to the insurance company. Only then the claim shall be processed. Now, the insurance company, let's presume, is using a blockchain network. The document, which is the contract, or what I can probably call it as the FIR, it is generated by the police. Now, you can't expect them to come on to the blockchain network. If we have an infrastructure like that, fantastic. But maybe over a point in time, it may get involved. It is too early for them to come into the system. So what will you do? You will appoint a third party who will verify, validate this document, bring it from off the chain to on the chain. And that person is an oracle. So data feeds are given by these folks, and they can build so many things. And an example from a DeFi perspective would be a price of a stock or fiat currency. Now I spoke about stable coins. It is linked with dollar, but dollar and euro price keeps fluctuating. Dollar and rupee keeps on fluctuating. Now who brings in that rate? An oracle will bring in. So he is a person who's off the chain, who brings certain things on the chain, and obviously he has to ensure this works on a trusted party. And from a cyber risk point of view, Oracle itself is a huge risk from various angles, and therefore protocol should be there. Audit of blockchain is some other base for discussion. So why has DeFi become very, very attractive? You're able to bring in new financial services or products, completely different. Now I spoke about few instances, and those are just an illustrative thing. They have crazy number of things. Second, the trust is trust minimized operation and settlement. Okay, rather I'll probably put it as the trust to a large extent. Your operations, whatever you're talking about, whatever settlement, you have a high element of trust because this is not based upon a centralized authority, and there is no custodial design. There is no custody. Everybody and anybody has it as long as the wallet is kept safe. Correct? It is open and programmable, just like an open source. Whoever wants can build in an API, of course, with some amount of security and protocols which will be built in. Correct? And this way it will be bringing in a lot of innovation. I'll speak about a few of these examples a little later. So we also understood this fundamental concept. It also makes sense for us to understand some bit of interrelationship between blockchain and DeFi. And obviously, blockchain came into picture because there were trust deficit. There's a huge fake minutes, and that is something which is happening today. Literally forward messages and social media posts which fake things are going onto the market. Anonymity. I am not able to trace who did what. Companies are not able to access quality capital, supply chains are having issues, there is a need for constantly reconciling yards and minds, and there is no single version of truth. And that's where a typical blockchain came into picture. Right? So I'm sure you know what a blockchain is, but just to give a quick recap, as I told you, it's a transaction which is broadcasted through a network of peer-to-peer players, and each and every player, or a majority of the player, or a protocol you can go ahead and define, and those players, if they accept, the transaction gets validated. And once this transaction is validated, that validated transaction gets added to a chain of transactions which is existing. So a block gets added to a chain of transactions, blockchain. Correct? And of course, then the transaction set up being completed. So blockchain is an append-only ledger. A sequential database keeps on getting added, maintained by decentralized network of users. That's a huge difference. Responsible for agreeing upon the additions and, more importantly, secure token. So that is the foundation or the basis on which a typical DeFi stays. There are crazy number of components in blockchain. Just to give you an instance, you have the typical SDK, the runtime, and the API, which is the dApps. You have the nodes who are authenticating it, the accounts and the membership. You have the key management, the private key and the public key. It's a peer-to-peer connectivity, correct? Just as much as Bitcoins happen. You have the miners who are actually doing it. Then you have a distributed consensus. A distributed consensus. That is the consensus, the essence of blockchain. You have on-chain data and you have off-chain data. I gave you a couple of examples and how oracles come into play. You have a crypto token or an incentive management or a cost saving. That is the reason why people may invest into a blockchain system. You have a distributed ledger, ledger to ledger interoperability, and beneath you have the underlying function, the infrastructure, the events, and the crypto. Okay? So this is a typical component of a blockchain, but we're not looking into component or architecture of a DeFi. We'll come to it in a couple of slides. And I also spoke about smart contracts. These are programs that prescribe terms, conditions, stored and processed on a distributed ledger, stays fairly dormant until it is cancelled by a transaction. Okay, and dApps are the blockchain enabled applications over which they use smart contracts, and they actually are able to solve the problem. So I hope I'm able to interrelate these concepts and clarify. And the last thing is Oracle, as I told you, the agent who verifies a real world occurrence and submits it to the blockchain, typically linking the off-chain and the on-chain. So my dear friends, now that I've spent a good 20-25 minutes clarifying or explaining to you most of the fundamental concepts, let's get into some bit of intricacies of DeFi. And that is the architecture, probably one of the core essence. Let me look into this entire structure. Come to the most fundamental, and beneath you have something called as the blockchain distributed ledgers. Now these blockchain distributed ledgers are the fundamental or foundation. Just like how we say, if we have to use a cloud infrastructure, internet is the fundamental requirement, same way blockchain. Point number one. Point number two. Then you have what is called as algorithmic stable coins, asset-backed stable coins, etc. Correct? And what you noticed on the green, I think the color coding is missing here, perhaps because of that expansion. What you notice on the green, these are all things on the, what I call it as the DeFi structure. These are things which is possible. What is not in the DeFi is what you find in the plain boxes: fiat-backed stable coins, fiat currencies, digital assets, which is not in the DeFi structure, but it can still, it acts as a basis. And the green is where you have the flow of data, and the red is where you have restricted flow of data. For instance, you want to give loans based upon, let's say, a typical a typical scenario such as your cryptocurrency. I want to issue loans based on that. Can I do it? The answer is yes. But can you trade those cryptocurrencies? The answer is no. So therefore it is locked in. So the red is where you have some way of lock-in. Whereas the green is where the flow of transaction happens, and the orange, what you notice, are flow of information, data. correct? And you have them various players. You can talk about credit, you can talk about derivatives, you can talk about insurance, you can talk about decentralized exchanges or aggregators, and a whole lot of structures like this are possible. The source of this is World Economic Forum. Interesting research they've come up with. So we got some fundamental and foundational aspects of this. It's time we spend some time to understand how is it impacting finance and where is it going to make a huge difference. First, they provide stability to cryptocurrencies, stablecoins, and this is where it will. Now, what happens in a cryptocurrency? There is a huge fluctuation. The Bitcoin fluctuation, which we just saw a few days back and we are continuously noticing, is a classical example. When a currency fluctuates to such an extent, nobody is in a position to trust, and that becomes, a fallback mechanism. And that's where a stable coin comes into picture, where unlike the centralized stable coins which governments are proposing to issue, by the way, okay, governments are proposing to issue centralized stable coin which is backed by the issue. Whereas a DeFi stable coin is backed by the smart contract and the consensus protocol. Correct? There is something which is a typical algorithmically designed, which is based on the price movement, which is based on factors where you have a cap and a floor. The fluctuation shall not happen beyond this, and a lot of interesting things. For example, the price of a DeFi stable coin which is backed by US dollar may probably fluctuate when there is actually a fluctuation or an economic crisis in the United States. So that has to be brought into the smart contract with the help of a oracle. Now that is where a DeFi stablecoin comes into picture. On the contrary, a centralized stablecoin is backed by the government. Some countries are actually proposing, China, Thailand are all coming up with concepts on this, and a few of them perhaps have already, started discussing on putting on consultation papers on this. In those scenarios, please note it is a centralized stable coin, and that shall be accepted by anybody and everybody. Why? It is as good as a digital currency, of course backed by crypto and whatnot methods. Correct? So that is where there's a difference between a centralized stablecoin and a DeFi stablecoin, and the DeFi stablecoin brings in a whole new game. Which means, please bear in mind, a centralized stablecoin may be acceptable only within a country. A DeFi stablecoin may be completely acceptable anywhere. Now you might be asking, hey, you're saying it is stablecoin. Now I have bitcoins. Can I convert my bitcoins into stablecoins? Definitely yes, possible. So what do you do there? When you have your bitcoins, you want to convert to a DeFi stablecoin such as DAI, you need to enter into an arrangement where, as on that day, whatever is the cryptocurrency value, you get them transferred to a US dollar. A classical example is, let's say when the dollar price was 60,000 USD versus this cryptocurrency, one Bitcoin, or whatever. I'm just saying 60,000, it may be 58, $59,000, whatever. You got them converted. Then what happens? You have one stable coin, correct, and it has got converted. Now basis on this, you can actually, it is as good as $59,000 only, irrespective of what the fluctuation is. Correct? Now can you do hedging based on this? Can you do trade based on this? The answer is yes. There are so many opportunities. So a stable coin seeks to maintain a constant value of a token. Okay, as I said, it's a token relative to some sort of an asset, and most commonly the asset is something like a US dollar, and that's the DAI currency which I spoke about. Now they're crucial to DeFi because they separate the risk return from the volatile digital assets. Now we all have understood that Bitcoin is a highly volatile digital asset. Therefore, in order to segregate the risk, that's where stable coins can come into picture. Now, when things are stable, it makes sense for you to purchase it. When things are unstable, it is extremely difficult. Classical example, Zimbabwe landed into a hyperinflation economy over a point in time, and you had to carry 3 to 4 suitcases of cash money just to buy a pizza and burger. And you know what? The person who was walking in there to the store when he was carrying those 2 to 3 suitcases of money, He was scared somebody will rob the suitcase, not the money inside the suitcase, because the suitcase which was carrying the money was perhaps more worth than that. So just give me a minute. I think I just got a notification in one of these apps. Sorry. Next, you can have lesser complicated DeFi exchanges. Now, this is a fantastic case, and this is where the Uniswap actually allows you to, swap between your digital currency and your DeFi. Now, what these DeFi exchanges do is that they perform a whole lot of these decentralized key functions. Now, imagine the stock exchange example which I told you. You have a buyer, you have a broker. It could be Zerodha, it could be ICICI, it could be Access, whatever. And the seller in turn has it. And of course, whom I sell to, whom I buy to, I have no clue, because we are doing it over an exchange. There are, of course, there's a lot of settlement engine, etc. Now, this settlement engine is replaced by a blockchain. These brokers are going to be eliminated. You just have one centralized or decentralized digital asset copy, and you have a matching engine which verifies and the protocol which takes care of it, and the entire software program takes care. So your order book, your buyer seller orders are matched thanks to the engine which is operating on or off the chain. If it is off the chain, we link it with the Oracle. If it is on the chain, we already have it. So what happens? Transactions are automatically passed thanks to the smart contract or peer-to-peer. Now there is something called as an automated market maker which can come in. Now let's understand what is a market maker. So market maker is a typical person or an exchange or a company, however you can call it, who provides a liquidity for an illiquid asset. What did I say? Who provides liquidity to an illiquid asset. A classical example is, let's say there are these stock exchanges. If you've seen any of these newspapers which have all of the share price information, of course, of late newspapers have stopped publishing it. But if you have noticed it a few years back, you will find a huge page where all tiny font you'll find. In that, if you happen to read, you'll find A category, B category, or Sensex companies, Nifty companies, which are traded, and you'll find something called as the Z category of companies. So these are companies who do not have high amount of liquidity. People have either invested and they don't know how to come out of it, or people are not interested in investing in it. That means you have invested, but the sort of funds is locked. Now, in order to promote these sort of companies, SEBI or the regulator came up with a concept called market maker, just like a currency. You can buy dollar and sell dollar whenever you're going abroad and coming back. So he has a differential price, which is the price between the buy and the sell, and that's called a spread. The same way, a decentralized exchange powered by automated market makers can give you that flexibility for regular liquid assets. But the biggest advantage is the spread between the buy and sell can be automatically decided on real-time basis. If you realize that there's a huge attention to a particular asset, okay, which happens in a few scenarios, then the spread can be reduced drastically, thereby you and I can be benefited. Correct? And there are companies like Uniswap, SushiSwap, who bring in a whole lot of these things, and you can do trade-offs. There's a throughput, latency, security, scalability, and a bunch of these benefits which can come. Third is a very, very interesting: DeFi credit and DeFi loans. The traditional method of borrowing is restricted to a large scale with that of a bank. Today, what I can do is, imagine I had surplus money, and that surplus money I parked it instead of a bank, I parked it in a centralized pool along with various fellows, and this pool gives an interest. The advantage for me is I get an interest rate higher than the banks what they're providing. And what is the advantage for the borrower? He gets it at a much cheaper price. If the banks are providing at 13%, he may probably get it at 10 or 11%. Probably 1 or 2% may be retained by the lending pool for the operational cost, and the balance is taken care of. Obviously, you have the element of credit risk. What if he does not pay back the money? That is always there. That is always there in any sort of investment. But they normally take some sort of a collateral which is actually helping out, and that is where these companies called Compound and AF Pool are actually bringing in. Lenders committing capital to DeFi credit services. They're getting some sort of a token and a guaranteed interest rate. Now what happens, there is the same sort of an interest which takes place, or a marginal difference considering, the operational cost. And there is definitely a collateral, and the collateral is a digital asset, either a crypto or something else. Say for example, a person has got crypto, but he does not want to sell it, and he can use that to rather borrow the money. And in the real world, he can actually use that money and make, financial transactions. So what also happens is they take sufficient buffer. We normally have a collateral. A collateral is a proof. You take a higher value. That's where your Bitcoin gets converted into stable currency or stable coin, and that's where it is taken care. For a borrower, even if he does not have a great credit facility, you can go ahead and give the loan, but because there is a backing up of collateral, so he gets an access, which in the traditional market may be a challenge. But let me remind you, these are still evolving. Can I say this is free of risk? The answer is no, it is still evolving. Last is providing an insurance. Can I provide an insurance setup for this entire scenario? The answer is yes. So what happens in a DeFi insurance pool is that whatever the digital asset you had, and then you had the capital. Now all of these are secured by you contributing a premium, that tomorrow if there is a hack, there is a malicious attack, there is a protocol failure or even a bug, or there's something, your interest is taken care of. And the expectation is that all of them have to contribute a small amount of percentage, and that pool is created. If there is a failure, there's actually correct. So you need to vote, or you need to typically decide whether is it something which is erroneous or certain things which is attracted, basis that decide. Unlike the traditional method where one person can probably engage in a deceptive practice and approve the claim, unlike the traditional setup. Let me remind you, all of these are just evolving. For instance, there is this Nexus Mutual who offers a smart contract based insurance. He charges about 2.6%, of the smart contract for bugs and provides various things. And the payout is also in the form of Bitcoin or ETH or DAI. And I told you DAI is the stable currency. So now they've come up with a lot more things which is backed by a blockchain, and even in the case of a hack or malicious intention, you are still protected. That means there is a newer type of services and protocols which are actually coming in thanks to this sort of infrastructure. The last probably use case which I'll probably mention is asset management. Remember, what can come into a DeFi is just not assets which we spoke of. I spoke of the land records getting digitized. I spoke of, probably examples of vehicles, examples of automobiles. All of these can be digitized and put in. And you can create perhaps an altogether a new market, quite similar to that of the derivative markets which you see. Correct? In India, derivatives are based out of, commodities, stocks, currency. If you look into US, it's based out of weather, it's based out of water. It can also be based out of cryptos, and that is where you can have a new class of assets. Just like how you have mutual funds, exchange traded funds, you can have ETFs, and that's where these 10 DeFi tokens, DeFi Pulse Index, all these things have actually come, and they can bring in a new range of services. So my dear friends, DeFi brings in a different set of opportunities which are fairly vast. So let's spend a few minutes probably before we wrap up into, looking into the summary, what exactly are the opportunities, risks, and challenges? From a risk perspective, the risk is obviously high, but it obviously comes with a return. You have the market risk. Tomorrow, if there's a fluctuation, tomorrow if there is something which says no against the entire setup. Counterparty risk, whether I will adhere to my terms, whether the other person will take care of it. Liquidity risks, and these are to some extent taken care by the blockchain. You have the technical risk, the software bug, the smart contract going wrong, the miner not agreeing for certain things and whatnot. There is a whole possibilities which can possibly come into the setup. Then you have the routine work, the routine maintenance upgrades, just like any other technology setup. the key management, the fork. And fork in a typical blockchain is that, the line of transactions which are happening continuously. Sometimes what happens is a typical 51% attack, the fork can move from the prominent one to the non-prominent one. So let's not talk too much into that. That's another area of discussion. Legal compliances, financial crimes, we keep on noticing that, the prohibited things unfortunately are taking place through the Bitcoin way. There is a so-called parallel world where Bitcoin is the official currency. Those are all issues. And from emerging issues, dynamic interactions, you're talking about price cascades, price crashes. So do we have the infrastructure and setup for all of this? So those are a few of these risks. Opportunities are huge. Your transaction cost can get reduced. And let me tell you, once this comes into system, your concept of Swift, your concept of your settlement is completely going to change. Between abroad to York, to India or vice versa, if funds has to be transferred, it does take anywhere between half a day to even 2 to 3 days. And if the banker is, or the bankers with whom you're dealing with are not part of the Swift network, there's a huge amount of charges. Correct? For every transfer, there's close to about $15 to $20. And imagine if there are $100,000 per day, 100,000 transactions per day. Imagine the volume. There is a standardization, interoperability is going to come into picture. Your auditability and transparency is going to increase because everything is backed by chain. Accountability is obviously extremely high. Your stakeholder control is going to significantly increase. 24/7 markets, faster settlements, permissionless innovation, all of these things are going to bring in a lot of new things. A few challenges. Scalability is a big challenge till date. People are arguing. Probably it's a question of time. Probably, when clouds move, probably the future is the entire world is going to run on cloud, which means that scalability is going to be to a large extent possibly be achieved. But it's a question of time. Energy usage is another area which is a big concern. I'm sure you have seen that, Elon Musk tweet which he made and things like that. Limited interoperability between various infrastructures, okay, and either has to interact with something else, a hyperledger or whatnot. Privacy consideration, but I still think that is something which can be addressed. Immature governance, because the entire landscape is just evolving. It's going to take a lot of time. And obviously, there are a lot of hidden centralization of controls, a lot of thresholds. So we do not know how these things internally work. Whether are they going to be accepted by regulators? Technology is evolving, and probably people are just looking into short term before looking into a larger perspective. And the financial crime I spoke of, money laundering, the things, the parallel economy, those risks are obvious. So where do we see the future of DeFi? The lot of these things are going to be predominantly based on the evolution of dApps and financial primitives. It may create newer instruments, newer services. I spoke of cryptocurrencies, I spoke of crypto mutual funds, ETFs. Correct? I spoke of lending and borrowing, trying to secure interest rates, trying to secure what I call it as your the risk, trying to secure your credit risk. Correct? So we're talking about all these evolutions which are going to happen, and we're seeing institutional players coming into the space. That's a very, very interesting thing. Correct? More sophisticated institutional traders are actually coming into the space. Speculative demand bubbles that produce spectacular returns over short term will not be sustainable. And we've seen that somebody says, hey, I made so much on a crypto trade, but that's just probably a short term phenomenon. So regulators will slowly start coming into picture. The World Economic Forum, has come up with an interesting discussion or blog or a write-up where what regulators will have to consider when they come into DeFi. Let me remind you, lending innovations, risk management innovations would soon be in the cards. We can go on and discussing, but for want of time, I'm just giving you a perspective. So what exactly is the summary which I want to draw? First, DeFi is an emerging and rapidly evolving area in this entire blockchain. So we've understood blockchain. We've also understood the DeFi setup. We now need to see the various business models in DeFi which is going to come in. All the examples of DeFi have existed much before, As I told you, 2020 saw a huge surge due to various reasons. Now, this DeFi aims to reconstruct and reimagine financial services on the foundation of what is the blockchain or the DLT. Not to forget your digital assets and smart contracts. So these are all the fundamental things. But I still feel it is nascent. It is definitely evolving at a rapid pace. So risks, potential, innovation, all of these are going to come very soon in the following days. So on that note, thank you so much for being a patient audience. We're obviously going to take a few question and answers just to have a thought process. And this is about me. I'm Narsimhan Ilangovan. Um, we can stay in connected through the social media or any of these ways of conversation. And not to forget, in case you're still interested, you want to get something more or better into enterprise blockchain, etc., you can probably log into my course. I had a small course on enterprise blockchain. The proceeds of that goes towards charity, so feel free to go ahead and enroll that. Okay, thank you so much. It has been a wonderful audience, and over to the organizer.
Thank you so much, sir. Okay, so we have one raised hand, and by the time I unmute him, I would request all of you all to put down your questions in the question box, or you can also raise your hand and directly speak to our speaker. Okay, so Mr. Ashish, I'm going to unmute you. Please go on ahead with your question. Hello.
Hello, very good evening, Narsama. Thank you so much. Very informative. I totally understand the point that there's so much to cover and so little time. So just wanted to quickly touch upon one particular and very interesting use case of NFT, which is to provide patent protection and royalty payout and things like that. So could you just touch upon that and throw some more light on how you see that evolving going ahead?
Okay, so let me give you the bare use case on how it happens on the blockchain, irrespective of whether it's a DeFi solution or not. In case of the royalty market, the biggest problem today is I am giving you a permission to record or to play something, and I really do not know how many copies you have sold or how many times somebody has heard that song or how many times a person or how many people have read that article or blog. Now, I purely go by a conviction or by whatever declaration you say, hey, this is how it happens. And many a times, those of them to whom who pay these royalty, they often involve in practices which are perhaps not ethical or may probably leave or not give you the accurate picture of the numbers. Now, given this scenario, don't you think you as an author, you as the owner of content, you as the producer of that are actually taken aback? The answer is yes. So what if I did a simple thing? I put this entire system on a blockchain network and on a smart contract. As and when the transactions occur, as and when the transactions occur, there is a notification which happens, and the fund, whatever is collected, goes into a pool or what you can call it as a nodal account, etc. And it is kept on hold for the time being, because normally there is that 5 days or 3 days of a return period. And assuming that is done, the funds get immediately released to you to the extent whatever your share of royalty is, and the balance goes to the person who actually probably is managing that media house or what. Or let's take a second scenario. I'm talking about a decentralized setup. Forget about all of these things. I made an album and I hosted on whatever of these platforms, and that platform charges even a small percentage, like even 10%, and the balance 90% comes to me, which earlier I used to get a royalty of close to 30 or 20% only, whereas now I'm able to get it, and I can market my own content. Right? We're talking about such level of distribution. That's called as the decentralization. Now, just to give one example, today if you want to author a book, okay, you write a book or an ebook, you can just go to the Kindle store and publish it. Amazon will charge X percentage and the balance is yours. Rather, you go through a book publisher, He will say, this is the guaranteed publication. Only after I sell this, after that I'll start paying you royalty, and there's a lot more things. Correct? So there's a total change in the way it approaches. You giving a license of music to, let's say, somebody like T series, they have obviously their own terms, and there's nothing wrong in it. That's their business model. They spend so much money into it. On the contrary, can it get decentralized? The answer is yes, and that is where you're having much more innovative products coming. Does that help? I hope I've answered your question.
Yeah, thank you so much for the question. Okay, so the next question is, due to so many coins in the market, how exactly does an investor identify the right one? Any tips on current assets that are here to stay, like the Bitcoin, Ethereum, Tether, or others?
Okay, so this is anybody's guess. Let me tell you, this is anybody's guess, because today you believe that Bitcoin is something which I have to go behind. Tomorrow you decide it's Ether, and day after it's something else. Correct? And this is just going to be fluctuating, and people are going to come up with much more currencies until a scenario or a situation where these currencies are either linked to a stable currency, or the interrelationship between these currencies are evolved and coming into a limelight. It is like you brought in a new product into the market, or something which is new, which can be tradable. So obviously you would ask, who would buy this? Either you're creating a new demand, or you are trying to offer this product to existing customer, which would mean that the customer has to get some sort of an incentive to buy your product. Correct? So how will you give that sort of an incentive? For example, when Paytm came into the market, everybody started accepting Paytm. Paytm started giving cashbacks, and that is how over a point in time they were able to achieve some amount of market. Likewise, PhonePe does it, likewise Google Pay, and the same scenario will happen. But it is a question of time, where and how. It's a question of personal preferences. It's a question of how well I am able to reach out and get connected. So all of these are a question of time. I do not have a single answer for that right.
Okay, thank you so much. So, okay, we have another raised hand. So I'm just going to unmute you, Mr. Nikhil. Please go on ahead with your question.
Hello.
Hi,
Yeah,
Nikhil,
please
please
go
go ahead.
ahead.
Yes, hi. Hey, we are discussing right now like decentralization of this finance. But
Yep.
from the point of view, like from the present view, we see that there are multiple Bitcoin miners and a mining community who like put up their own labs for the processing of these transactions. So when we say this is a decentralized, there is no central system. So how do we expect like the regulator to play a role in this? Because the ledger
So
will be like distributed, correct?
currently, the entire concept of DeFi is not backed by any set of regulations. Any set of regulations.
Okay.
People are coming forward thinking of what could be the future. And that is where discussion papers, consultation papers are across the globe. These larger chains are actually coming forward and proposing this is how you should perhaps approach a DeFi framework. Now, what could probably happen is put a hybrid approach, just like how we are going to have a hybrid approach after this COVID situation. We're going to have work from home as well as physical working. It's going to be a combination. The same way, a DeFi backed by some bit of government and open
Hmm.
source tools can probably come into picture. So when we talk about both these things, and that is where a combined approach may probably be something which we can expect. So as we speak, there is no way regulatory intervention in this space, which may also be a reason for risk, which may also you may feel that how does it matter because I trust the system and I go forward.
Okay, thank you for the answer, sir. And I'm really sorry, Mr. Nikhil, I had to mute you because there was some sort of noise coming from that end. Uh, but thank you so much for the question, and thank you so much, sir, for joining with us. It's always a pleasure having you. We learn so much whenever you come and join with us. And this was also one of those occasions. So we look forward to more sessions with you. We look forward to having you around more.
Sure,
So
always a
thank you so
pleasure.
much, sir.
You take
Thank you
care.
so much,
Bye.
sir. And to the audience, I would like to let you guys know that InfoSec Fusion, once again, I would like to let you know that we have our fifth anniversary session InfoSec Fusion going on. And it right now we have a 90% discounted price on that, which is 555. And please make sure that you go and register yourself before the seats are all full or the prices increase. So I hope all of you all have received all the links which are there in the chat. And thank you so much for connecting. We'll see you again in the next CF Thursday.